Hi everyone. So we're going to start off today with this political cartoon, and you can see it's asking, how does the government stabilize the US economy? And you can see that Uncle Sam has a fiscal policy toolbox which has spending and taxes in it, which we've studied already in past modules. And then he has a monetary policy toolbox which has some labels: reserve ratios, discount rate, and open market operations. And that's really what we're going to be talking about today. So these, in his toolbox, are going to be the three shifters of the money supply, because managing the money supply is what the Federal Reserve does in order to stabilize the economy in times of high unemployment, recessions, depressions, and high inflation. So these are the three things that we're going to be talking about today, and we can loosely call them the tools of the Federal Reserve. So tool number one is called the reserve requirement. And you've seen from previous videos that this is the percentage of deposits that banks must keep in their vaults, right? So they could keep them in their own vaults, or they could keep them on hand with the Federal Reserve, but they have to keep a certain amount of reserve requirements. Usually we say about 10%. Banks probably don't quite keep that much on hand, but it's just a good number to illustrate what's happening. So you should have already read about the money multiplier, but we're going to go through it again. So if you assume the reserve ratio in the US is 10%, and you deposit $1,000 in the bank, your bank must hold $100 of that. That's called required reserves. Well, what do they do with that extra $900, which we call excess reserves? Well, of course, the bank wants to lend that out because that's how they make their money. They lend it out to Bob, and Bob either purchases something with it and the business owner deposits it, or Bob deposits the $900 in his bank. Bob's bank has to hold $90, but then loans out $810 to Jill. Jill deposits $810 in her bank, and so on and so forth. So that keeps going until all the money has been used up through loans. So far, the initial deposit of $1,000 has caused the creation of another $1,710 from just the first two rounds. And so we have here the money multiplier is 1 over the reserve requirement, the ratio. So 1 over 10%, or 1 over 1/10, is going to be 10. And so in this case, the money multiplier is 10. And here's an example. If the reserve ratio is 20% and the money supply increases by $2 billion, how much does the money supply increase? Okay, so pause that and try to work that out. And if you're coming back now, a reserve ratio of 20% is going to have a money multiplier of 5, right? 1 over 1/5 is going to equal 5. And so that $2 billion is going to multiply into $10 billion of money floating around there in the economy. So how does the Federal Reserve use the reserve requirement? Because we understand it's a tool, we understand it connects with the money multiplier, but what happens? So if there's a recession, what should the Fed do to the reserve requirement? Well, your initial thought should be that they should lower the reserve requirement in a recession. Well, why is that? If they lower the reserve requirement, there's going to be more money to lend, right? More loans will be taken, and then that will increase consumption and investment, and that will increase aggregate demand. If there's inflation, what should the Fed do to the reserve requirement? Well, it's the exact opposite. They should increase the reserve requirement, which forces more banks to hang on to their money. They cannot make as many loans, so less loans are made, less consumption, less investment, and less aggregate demand, which brings it back in line. Now there's this little point in there which we will talk about right here called the money supply increases. There's a specific graph that we're going to learn that that connects with interest rates, and we will get to that. But the basic line of thought is the same. So we go on to number 2, the discount rate. The definition of the discount rate is the rate at which Federal Reserve charges member banks for borrowing money. So let's say that at the end of the day, a bank is short on the amount of money it has to have for its reserve requirement. Well, it can borrow money from other banks, just like any consumer, or it can actually borrow money from the Fed. And that discount rate, that interest rate that they charge to the banks, is called the discount rate. And they do it through what is called the discount window. And raising and lowering this rate can also help manage the money supply. So the discount rate is the interest rate that the Fed charges commercial banks. If Bank of America needs $10 million, they borrow it from the U.S. Treasury, but they must pay it back with 3% interest. So that 3% is the discount rate. So what should the Fed do if they want to increase the money supply? So the Fed should lower the discount rate. We call this an easy money policy. And what will that do? That will encourage people, encourage banks to take more loans from the Fed, thus having more excess reserves on hand in their own banks, increasing loans to average users, and thus increasing the money supply. And the exact opposite. To decrease the money supply, the Fed should increase the discount rate. And we call that tight money policy. Now, just a quick note, there is another rate called the federal funds rate, which closely matches the discount rate but is not actually controlled by the Fed. They try to control it with some of their other tools, but pretty much it matches the discount rate. And this is the rate when banks borrow from other banks, and these are called overnight drafts. And so basically these are one-day loans when you just don't meet your reserve requirement at the end of the day because you made too many loans that day. Okay? Banks decide on their own, but the Fed targets that rate and uses our next tool to actually hit the target. So just to show you, here is the effective federal funds rate from 1955 to the present. And you can see that it has fluctuated through its history, gotten as high as 20% in the 80s. But what's very interesting is what has happened actually in more recent times. During the Great Recession, which we'll be talking about in depth later on, you can see that the federal funds rate went almost effectively to zero, which meant that banks could borrow from other banks for effectively free. Okay, and we'll talk about why the federal government, attempted to create that policy. So there's Ben Bernanke cutting interest rates during the Great Recession. So this is the graph that I actually really wanted you to see, and just to show you that the discount rate closely matches the federal funds rate, which shows you that the Federal Reserve has a really strong ability to target that federal funds rate and make sure that it closely matches the discount rate. Otherwise, you could imagine there would be, some pretty serious what's called in economics is what is called arbitrage. If you could borrow from the Federal Reserve at 3% and then loan to other banks at 4%, well, then that's the way you would make money. So you really need those two to be pretty close. The final tool is called open market operations. And this is basically the buying and selling of government bonds. And we're going to talk really quickly about what that means because not everybody knows. So there are three types of government securities or government bonds. We call them securities or bonds. Treasury bills, which usually mature in less than a year, so you buy it at a certain interest rate, and at the end of the year you collect the interest and you get your cash back. Treasury notes, which has maturities of 1 to 10 years, and then Treasury bonds, more than 10 years. Okay, so those are long-term bonds. Here's what one looks like. You can see this says $100,000 payable, issued in 1969 and payable in 1970. You can see that this is a Treasury note, Treasury bond of 1964, and it looks like you can get it back in 1972 if it's not too blurry. And then Treasury bonds last more than 10 years, right? So you can see that this was purchased in 1977 and it's due in 2007, right? And it's paid, the interest is paid continually throughout, but the bond matures and you can get it back. So, open market operations is when the Fed buys or sells government bonds. Now, the most important thing to understand here is that you are pretending that you are the Federal Reserve. This is important because it's not you as a consumer buying a bond. When the Fed buys a bond, what happens to the money supply? So let's go through this. To increase the money supply, the Fed should buy or sell government securities. Think about it. Well, if you're thinking like the Federal Reserve and not like a consumer, the Fed should buy government bonds. Why is that? Okay, because a government bond is a piece of paper, and if you're the Federal Reserve, you are buying that piece of paper and handing the owner back cash, whether that's $10,000 or $100,000, and now that cash is in the economy. Okay, if they want to decrease the money supply, the Fed should sell government bonds, because what they are doing in essence there is taking the cash out of the economy and replacing it with a piece of paper. Now, can you go to the store and purchase groceries with that piece of paper? No. Can you buy new cars with that piece of paper? No. So you are in fact decreasing the money supply if you are selling government securities. So here's a way to remember: buy big, buying bonds increases the money supply; sell small, selling bonds decreases the money supply. So in our next video, we're going to discuss how these tools eventually affect aggregate demand.